RBI has cancelled the banking license of Paytm Payments Bank, and this is a very important case study when it comes to the fintech governance. And this relates to your GS paper 3, that is Indian economy and the banking reforms. It relates to GS paper 2 as well, regulatory bodies and even the RBI autonomy, and to GS paper 4, that is the corporate ethics and governance. It also raises a very important question, and that is, can innovation survive without institutional integrity as well? Now, when it comes to the complete news, so RBI have cancelled the banking license of Paytm Payments Bank Limited or PPBL, and this will be effective right from 24th of April 2026. And over here, the major problem was the persistent material supervisory concerns that were persistent with the bank, along with the systemic non-compliance with the KYC and AML norms that this bank had done. All right, now over here, one most important thing that you have to understand is that this impacts the payments bank, that is Paytm Payments Bank, but it does not impact the app as well. The app will continue because the app is a separate entity that is there. All right, so you do not have to worry when it comes to Paytm's app. But at the same time, the Paytm Payments Bank Limited had been, the operations had been seized completely by RBI. And RBI had over here taken the legal basis and invoked the Section 22 of cancellation of Section 22 that deals with cancellation of license, and even Section 35A of the Banking Regulation Act as well. All right. Now, when it comes to the timeline, so in 2018, it was the first time that a supervisory warning were issued by RBI, but they were, overlooked by the Paytm Payment Banks Limited. In 2022, cease and desist orders were passed, and new customers, their onboarding was discontinued. At the same time, 2026, the banking license had been cancelled, and this is the first time that it had been done for any of the major fintech industry that we have. So in June 2018, it was the first red flag, and in the RBI audit, it had revealed critical gaps in the basic customer verification. New onboardings had been, halted. Then in 2022, in March, there was escalation where persistent compliance failures were there, and that had led RBI to impose a strict renewed ban on the onboarding of new customers. In October 2023, financial penalty was levied, and there was a penalty of 5.39 crore rupees that was levied for severe non-compliance with the KYC and cyber security as well. In Jan-Feb 2024, there had been operational fleas, and RBI had barred the Paytm Payments Bank Limited from accepting deposits, top-ups across the wallets, and even the FASTags as well. In April 2026, over here, this is 2026. All right, so in April 2026, there had been a fatal blow that we have seen. All right, we have seen a fatal blow that you can see, and complete cancellation of the banking license. Operations will be wounded up under the High Court supervision that had been decided by the RBI. Now, when it comes to the payments bank model, so it was recommended by Nachiket More Committee. Now, it is again important for your prelims. In 2013, payments bank were designed, or they were recommended, where these banks were designed to drive the financial inclusion of for the migrational labor or migrant labor that are there, and low income households through the small savings as well as remittances schemes or services. The key constraint that these banks had, all right, the payments bank, they cannot issue the loans or credit cards. They also have a ceiling on the deposit. Only 2 lakh rupees could be deposited per individual, and they must invest 75% of the demand deposits in the government securities, and that is the SLR requirement that had been placed for the payment banks. All right, over here, they are not like the universal or commercial banks. The payment banks are narrow by the design, and that is the safety over the scale that had been implemented while moving ahead with the payments bank in India. Now, what are the core issues and the violation, and why this is or it was necessary? The first thing was the KYC malpractices, where the thousands of the accounts, they were linked to single PAN card or PAN number, and that have created massive potential for money laundering and the identity fraud as well. At the same time, there was lack of transparency and clear separation between the parent entity, that is 197 communication, and the regulated banking arm as well. There had been sensitive customer data that was shared with the non-regulated group entity, that is 197, and it had violated the mandated firewall that is there between the regulated and unregulated entities. And also there had been non-compliance, there had been repeated failure to remediate the deficiencies which had been flagged by the external IT auditors and the RBI on-site supervisors over multiple review cycles that had been conducted. Now, what will be the dimension of this crisis? So, the Paytm payment bank failure, it extends to far beyond the complete, simple regulatory breach. It reveals that there are systemic fractures across multiple governance dimensions. The first one is that the promoter dominance over the board, it had undermined the independent oversight and accountability. So, this leads to the governance, fracture. At the same time, there had been erosion of the public's trust. This is a systemic threat to India's digital payments ecosystem, and also the algorithmic black boxes which are used for the KYC. They can conceal and also not prevent the systemic fraud. That is again very important thing that to know that has to be noted over here. And also unverified accounts, they create the pathways for the money laundering and also for the potential terror financing as well. These are the certain things that have to be taken into the consideration while going through this news. Now, when the underlying failures that were there were the hypergrowth and the valuation that were prioritized over the regulatory hygiene. So this was a culture of move fast and break things. At the same time, the fintech innovation had outpaced the development of the supervisory frameworks as well. So there is a regulatory lag as well. That is a pacing problem between the innovation as well as the supervisory frameworks, and inadequate internal audit mechanism were there. All right, and ultimately that is the form over substance. So that is again very important to note that these are the root cause why the fintech have failed in India. Now, there would be certain ripple effects that we will see. The short-term disruptions will be there. The millions of the users and merchants, they will be forced to migrate to the competitors, including PhonePe as well as Google Pay. And that will cause immediate friction in the payment ecosystem that we will see. At the same time, there will be long-term structural shifts as well that could be seen from this perspective. There will be higher compliance cost for all the fintechs. At the same time, when it comes to VC or PE funding, it will now demand regulatory diligence alongside the growth matrix and the sectoral pivot from the fintech first to the bank-led fintech models. That is the structural shift that we will see in the longer term. But at the same time, when it comes to this particular step, so over here, the decisive action that had been taken by the RBI, it will strengthen the image of India as a strict but fair regulator, where we are protecting the systemic financial stability while remaining open to innovation as well. And therefore, this position India favorably in the global forums like the Financial Stability Board or the G20 discussions that are there over the fintech oversight. Now, over here, there were certain regulatory responses that government as well as the RBI did. RBI had appointed an administrator to manage the complete wind down and direct the orderly shifting of the nodal accounts to protect the depositors' interest. All right. At the same time, RBI has also it also continues to encourage the fintech innovation in India, but under the controlled supervised environments, and therefore it separates the innovation from any kind of systemic risk. RBI had pushed for the self-regulatory organizations as well to foster the industry-wide compliance standards and the peer accountability as well. And when it comes to the NPCI, that is National Payments Corporation of India, NPCI ensured that UPI interoperability should be there during the transition, minimizing any kind of consumer disruption and even maintaining the payment system continuity as well. Now, what could be the way forward? The first thing is that RBI must embed a tech supervisors, or it must embed the tech supervisors, the regulators who can audit the code, they can audit the data flows and algorithmic KYC, that is know your customer systems in the real time. There should be mandatory SROs as well, that is self-regulatory organizations. All right. Every fintech subsector must have its own or self-regulatory organization with the statutory backing and even genuine enforcement powers as well. There should be stricter arm's length rules as well. Absolute separation of data, management and resources should be there between the parent tech firms and their regulated banking subsidiaries, and there should be a complete shift. The shift of the national narrative from the digital literacy to digital financial safety. That will empower the users to demand the compliance from the various service providers which are there. So we must move forward with the digital financial safety as well, instead of, or we should shift from digital literacy to this. So this is the new normal for Digital India. The compliance is not an option, but it is the license to operate as well. At the same time, this news is again important because the rule of law now it applies to the virtual world as well, as much as it applies to the physical world, and the digital scale does not confer the regulatory immunity. So that would be all in this video and this session. But before moving ahead and winding up this session, let me tell you that if you are preparing for the civil services, all the UPSC courses are now at 50% off along with double validity. All right. And for grabbing this offer, you can use the code BRS Live. And please remember that this is a limited time offer. So again, if you want to enroll, this is your time right now. And these are the two important courses that we are running on the platform for the GS Foundation for UPSC IAS 2027 and for 2028. This is Resolution P2I batch, which is available in English, Hindi and bilingual medium as well. Again, you can use the code BRS Live so that you gain the maximum discount that is there. So that would be all in this video. Thank you very much guys for joining me over here. At the same time, I wish you all the best for your exam. And also do not forget to like the session, share the session with your friends. Do write down in the comments whatever the thing that you want to suggest and also what you want to add. And that would be all. Do not forget to subscribe to our channel so that you do not miss any of the updates in the future. Thank you. Bye-bye. Take care and Jai Hind.